Assalamualaikum. As of the introduction, we will start with engineering economy, which plays a crucial role in engineering decision making. So it helps us evaluate project alternatives by comparing costs, benefits, and risks, not just during construction but across the project's entire life cycle. So in this project, we applied key engineering economy tools like benefit cost ratio (BCR), life cycle cost analysis (LCCE), and time value of money (TVM). So this allowed us to assess the long-term financial uh, feasibility of constructing a new community college in Johor. So the focus to evaluate two proposed sites and assess which one brings greater economic return over time. In addition, we assess the financial strength of the contractor, IJM Corporation Berhad, using their audited annual reports from 2023 and 2024. So our project also applies the seven principles of engineering economy, such as developing alternatives, focusing on differences and making uncertainty explicit to guide logical and data-driven decisions. Now, I'll be presenting an overview of IGM Corporation Berhad, the company we selected for financial evaluation. So, IGM was established in 1983 and it is one of Malaysia's top public listed conglomerates in construction, infrastructure, and property development sectors. So, the company is headquartered in Petaling Jaya, Selangor, and is well known for delivering large scale public and private infrastructure projects, including roads, highways, ports, and residential townships. IGM's vision is to deliver sustainable value to stakeholders while its mission emphasizes excellence through innovation in civil and infrastructure development. So in this slide, uh, we summarize that IGM's financial performance for the last two fiscal years. So for the revenue grew from 4.57 billion in final year 2023 to 5.92 billion in final year 2024. So the net profit attributable to shareholders increased significantly from 158.3 million to 600.3 million. And earnings per share (EPS) also improved from 4.49 cent to 17.11 cent, which an indication of strong profitability per share. So these figures show a positive financial trend, which is important for assessing whether IGM can handle the capital requirements of the community college project. Now we will look deeper into ITM's financial performance using three key financial statements. So the first one is the income statements. For the income statement, ITM's operating revenue increased by over 1.3 billion from final year 2023 to final year 2024, and the net profit rose by 279%, showing the company has recovered well post-pandemic and is managing costs efficiently. For second is the balance sheet or statement of final position, which IGM's total assets grew from 20.6 billion to 21.31 billion. Although there was a slight reduction in retained earnings and cash holdings, the company maintains strong equity and stable liabilities, which means it has enough capital to support new projects. And lastly, we analyze the cash flow statement. While there is negative cash flow from operations due to intra-company transactions and investments activities, this is offset by income from subsidiaries and dividends. So the company also continues to distribute dividends and has not shown signs of cash distress, which reflects healthy liquidity. So in summary, this financial evaluation gives us insight into IGM's current strength and sets the foundation for the next section of our analysis, where the project sites option will be evaluated using economic tools like the benefit cost ratio.
Assalamualaikum warahmatullahi wabarakatuh. My name is Faiz, CF22017. For project background, the Community College Develop project in Johor was created to help Malaysia meet its national aim of providing access to high quality technical and vocational education given the increased demand for skilled personnel in southern region, particularly in Johor industrial and service sector. This project is being efforted strategically to build educational and infrastructure while also boosting the state associated economy. And after that, this develop is championed by IGM, Corporation Berhad, leading infrastructure and construction company in Malaysia. And they have a innovative project management. IGM also strong track record, along with the financial capability, make it fitting implementer for project of this scale. And then after that, for BCR, benefit cost ratio technique assess to potential project location, taking to both initial capital spending expected benefit over 6-year period, and include cost of purchasing property, construction, operating, and other else. And after that, this project will apply engineering economic principle to drive site selection. The ultimate goal is to improve educational access while determining national goal for sustainable development and economic inclusivity.
Okay, today we'll present about the benefit cost ratio method. The benefit cost ratio method (BCR) method is a financial evaluation tool used in project management and economical to assess the feasibility and the profitability of the project. It shows how much the benefit a project given compared to its cost, making it easy to decide if the project is worth doing. And you can see this is the formula of the BCR. Total benefit present value divided by total cost present value. Benefit cost ratio remain a widely used approach for making informed investment and the project management decision.
Now I will present my part, which is the benefit cost ratio method, and that is the calculation from BCR inside A. So in this table given, we can see that there is the clearly to summarize of the total cost and total benefit from the year 0 until the year 5. And the right column is the initial investment, and the purple column is the operation and maintenance cost, and the blue column is the benefit. In benefit cost ratio method, the Blazonov is the important thing that we need to calculate. Inside A, the Blazonov we can get from the discrete compound table, and we apply the 10% as the assumptions, and the given of the year is 6 year. We follow the sequence to apply starting from the year 1 until year 5, and the year 0 is the special case with the Blazonov equal to 1. So we times the benefit that given in the table and find, and then we need to summarize of all the Blazonov. Moving on, Blazonov with the operation and maintenance. The table is given year 1 until year 5. The Blazonov about the operation and maintenance that we apply is following the sequence in the discrete table, and the years we take is 6 years, and the assumption is 10%. That is the set method that we use, and we can get the Blazonov. After we calculate Blazonov calculation, one of the important calculation that we need to calculate is the annual worth calculation. The same assumption and the same benefit cost ratio that we use, and the capital recovery that we use is get from the same table with the discrete compound table, and n equal to 6. So we get that there is the 0.2296. So we times the total Blazonov and the total Blazonov of the benefit and operation and maintenance. Hence, we times the ASP, we get the annual worth. For conventional and modified method, Blazonov equal to PWB divided initial cost minus PW MV market value plus PW operation and maintenance. Hence, we can get the BC equal to 1.05 for conventional method. In modified method, we use the formula BC equal to PWB minus PW operation and maintenance divided initial cost minus PW MV with the market value. So we can get the same value with the 1.05. That's for the 1.05 bigger than 1.0. there is the accept project inside it. For conventional and modified method in annual WOF, the annual WOF formula we can use is BC equal to AWB divided initial cost minus AW market value plus AW operation and maintenance. So we can get the value BC equal to 0.247. And for the modified method, the formula applied is BC equal to AW benefit minus AW operation and maintenance divided initial cost minus AW market value. So we can get the final result is 0.242, which is the smaller than 1. The project is not acceptable. Hence, for the analysis result, we can conclude that this Weizenhoff analysis is suitable for site A. The BC ratio that we calculate is 1.05, which is the bigger than the 1. So we can conclude that this project in site A is economically valuable. That means benefit exceed the cost. That is the not suitable for annual WOF analysis. The BC ratio is smaller than 1. So we can conclude that is the not financially sustainable on annual basis.
Okay, so for my part, let's look at side B. For the side B analysis, based on the table, 15 discrete cash flow, compound interest factor. So we use on assumption interest rate is 10%. So on 10% here, we use the present worth of from 1 N1 to N6 value. So start from 0.9091 to 0.5615. So for the capital recovery and present worth is we use 0.22961 and 4.353. So these are the value that we are going to use to find the annual worth and to calculate to obtain the annual worth from there. So these are the table we use, and we use the 10% interest rate. Okay, for this part is you can see that look at this image here, which is used for side B, present the value for benefit obtained to calculate annual worth. So as you can see here, the value here cost and the total benefit that we obtain from this is 19,000, and 919,112,000. So that's the total benefit. And for the operation and maintenance here, we got from start from 1 to 5, 1 to 5, 118,000 to 122,000. So these are the value that we're going to use to calculate annual worth. So these are the operation and maintenance. Sorry, these are the operation and maintenance. So for the annual worth, we will calculate times we use the value of present worth, and then times with the present worth and the operation maintenance. Then we will get for the value for the annual worth. So these are the table analysis of the cost and benefits. Okay, so now we're going to calculate the present worth, benefit and operation maintenance. So as we got from the table, side B, starting from year 0 to 5, which is start from n equals to 6. So we start with the total benefit of 14 million, 14 million, and then with times with the present factor is 1.1.0. So you will get the present worth, and from there we calculate all the benefits obtained, 293,000, and then 295,000, and then 300,000, 300,000, and 335,000. For the first table, we times with the POF, and then we will get the present worth. So then we total up. So that's the present worth for benefit. Okay, the next one is present worth for operation maintenance. For the operation maintenance, as we look for uh, side B, so 1 to 5 n, and the operation maintenance is 100 18,000, 118,000, and then 122,000 and 122,000. So we times with the prison norm factor POF, and then you will get the prison work. So prison work will then we sum up, and then we will get the total value of the prison work of operation and maintenance. So that is how we calculate the benefit and operation maintenance for the prison work. Okay, to calculate the annual worth for benefit and operation maintenance. So first we need to use the A over P, which is capital recovery, which is 2.296. So for the total present worth, 15,861,445 ET. We times with 2.296, and then we will get 3,641,787. And then for the prison worth for operation and maintenance, so our same goes to that. We times with A over P, and then we will get the annual worth and for operation and maintenance. So that is how we calculate for annual worth. Okay, so for the benefit cost ratio, we use the method of two method, which is conventional and modified method. So for the conventional method and modified method present worth, we use to calculate, and then we got BC is lesser than 1, which is 0.81. And for the annual worth, we use the formula conventional method and modified method to calculate, and then we got lesser than 0. We got lesser than 1, which is 0.190. So this, according to this analysis for side B, the benefit cost ratio is 0.81, meaning that the project's cost is higher than the expected benefit. So the project is deemed economically unviable, and if the ratio is lesser than 1, because the anticipated returns do not cover the investment. So this finding implies that the suggested development will not be prudent from an economic perspective, and does not justify the expense incurred under the current assumptions and conditions. So we don't accept the Site B project because both of the annual word and present word is lesser than 1. So that is what we got from the analysis result for Site B.
Hi everyone, I will present about the project status. This is the principle of the engineering economy. First one, develop the alternative. For this process, we need to know the problem of the problem that happened at the college community. For example, a cracking in the foundation. And by this, we need to propose the alternative to solve this problem. By first one, they implement a preventive maintenance program based on life cycle analysis and historical data. And second one is perform a cost benefit analysis. Number two, a focus on the different. By that, we need to know by this process, we need to know the difference between of the two proposed that have been choose. And number three is view a consistent viewpoint. By this one, we need to viewpoint the alternative that have been proposed. For example, the first one is implement a preventive maintenance program based on a life analysis and historical data. By first, we need to know a regularly inspecting and extend their lifespan. For performing a cost benefit analysis, we need to compare the cost of the renovating or replacing outdated facility with a potential benefit. Number four is use a common unit of measure. For this process, we need to compare a different service across the department and this demonstrating value to stakeholder. Number five, we need to consider all relevant criteria. By this process, we need to review again all the criteria of the purpose that have been chosen. And number four is make uncertainty explicit. We need to know the advantage and disadvantage for this purpose to solve this problem. And the last one is revisit your decision. By this process, we need to determine to choose either of those options require carefully what lead to the benefit and drawbacks as well as the center organization and budgetary limitation. By performing a true cost benefit analysis involving a stakeholder and seeking professional guideline, college administrators can make an informed decision that optimizes the resources allocated and ensure the long-term sustainability and well-being of the college community.
For discussion, research employee BCR technique to assess the financial sustainable of construction community college. So for IGM Corporation Berhad is carry out the project. Firstly, economic variability through BCR analysis. And then financial help IGM Corporation Berhad. And then application of engineering economy principle. They have to determine on and compare feasible alternative and determine benefit using a standard unit. It is RM. And after that, they have a strategy project justification by using the SDGs 4, SDGs 11, SDGs 9. Quality education, industry innovation, infrastructure, and sustainable city community. And after that, limitation and recommendation. And there have sensitive analysis to be carried out. Look at the effect of change interest rate. And absent site B investigation could have impact how through the location section provided was. And estimate of cost and benefit are predict on projection. And also forecast data assumption from the basis of cost and benefit estimate. And last, the limitation annual worth method point to marginal economic variability annual basis.
In conclusion, this community college project cost a benefit analysis is seemingly more variable than what is necessary. By using both an annual value and the current worth, the benefit cost ratio is above 1.0, meaning that the project cost of this project are underestimated in the comparison to the project estimated cost of the project less than the estimate benefit. The project is financial variable to undertake. In this case, generally a benefit cost ratio higher than 1.0, meaning that the project cost is reasonable manageable considering the expected benefit it will be generated during its lifetime. In other words, it implement the good result or more than enough financial return of the project make it well worth undertaking. Economy analysis often consider project with a benefit cost ratio higher than 1.0 can be considered more feasible since a higher return rate of investment will be achieved from such project of in other team a low sum of the lost resources is involved in such project. Pre-decision present prior to lost decision on a specific project is answering because its a financial viability is already sufficient. Nevertheless, it's relevant to the continued existing another option of considering adjustments that might increase the financial viability. That's all for me. Thank you.